of the session as well. So we're having around 398 participants joined in from the different Zoom calls. And welcome to all the 450 participants now. And sorry for the number. So we have around 450 participants joined in from the different Google Meets and Zoom calls connected all together. So without wasting any time, we shall be discussing further about when we are talking about a company. Okay, so this would be a general kind of an understanding or a general discussion where I will help you guys understand that whenever you are analyzing any kind of company, be it from any of the sector, any company from any of the sector, then what are the few parameters that you always need to take into consideration? Though I have devised separate modules upon that, and those are there on the website as well. But still, whenever we are analyzing any company in a particular sector, we need to understand that which of the following metrics or which of the following scenarios we have to take into consideration while we are analyzing a company in detail. So here I won't be talking about particular ratios because separate session sector-wise has been uploaded on the website as well. The different ratios for different sectors. So this session won't be categorically be talking about the liquidity ratios, the activity ratios, the capital structure ratios, or basically the separate ratios for banks or separate ratios for the insurance sector or the IT sector. So here I'll be talking about in general that what you guys need to do whenever you have a target company in place, because you know that what are the financial ratios and what are the different financial ratios for different sectors. So this knowledge is available with you through my previous live sessions or through my recorded modules. Okay. So apart from those financial metrics, we need to understand, for example, if we get a company that we have to do some research upon, right? So just assume that you are working for a profile of an equity research analyst or associate, or maybe as a portfolio manager, and they give you a company A, right? So here you have a company A, and what you have to do, you have to analyze the company A, how well the company is doing currently, how well the company has been doing in the past, and how well the company will do in future. So if there is a company A, you have to make your own interpretations, your own conclusions, and you have to communicate the results of your interpretation or the, I would say, work analysis to your manager or to the client or to your stakeholder. So all these kind of analysis need to be done. So how will you do such kind of analysis and from where will you start? So for example, if you get a company A, your first parameter would be you have to read about the company, right? Now, reading about the company can be done through the annual report of the company, and that is one way. Because the annual report is the best way in which you can get to know about the company. Just open the annual report of that company and try to understand the business of that company. Now, here I'm not saying you to calculate the profitability or the cash flows or the liquidity ratios or the debt capacity of the company or trying to calculate the corporate profitability or the free cash flows. No, that's a later part of the discussion or a later kind of an analysis that you guys going to do. But the first thing is that you firstly have to understand the business of the company. It would be far good if you would have been tracking that company over past years. But if you have not been tracking that company over past years and that company comes in front of you, the first thing is to understand the business of the company. For example, just assume that the company is into the fast moving consumer good industry, FMCG. In that case, you have to analyze the products of the company, the different kinds of products and services the company is offering, the pricing of the companies, the sales of the companies, or the volume of the companies, whether the company is a premium company or a company is a mediocre company. That is, whether the company focuses upon pricing and less volume, because the premium companies, the companies that are premium or the luxury companies, they tend to focus more upon pricing and less upon volume. For example, BMW, Audi, or Mercedes companies. So these are from the automobile sector, right? But in general, when the companies are from the luxury space, right? The luxury space companies, they tend to focus more towards what? The luxury companies tend to focus more towards the pricing strategy, right? That pricing strategy is more often place instead of that volume strategy because they want to focus upon the price and less upon volume, right? Whereas the companies that belong to the mediocre space, they might focus upon more volumes. They might give more discounts and focus less upon pricing. So the company can increase its sales or the company can increase its revenue either by two means. One is the volume means, and the second is the pricing means. Either the company can increase the volume and reduce the prices, or in the second scenario, the company can reduce the prices and increase the volume. But any of the strategy the company is following, the company must be able to get success into that. It should not that the company is going for the pricing strategy, but the volume strategy should have been good for that company, or the company had gone for the volume strategy, but the pricing strategy had been good for that company. No, whatever strategy the company is into, whatever strategy the company is into, that must be clearly being followed, and the company should be able to get success over the past years when you will analyze that company. Try to analyze the good products of the company. Like for example, if you are trying to analyze a company called Nestle, then you can see the which products of Nestle command the maximum market share or command the maximum sales, like Maggie, pasta, noodles. You have that ketchups, right? And you have that yogurt and milk products, right? So which part or the which product in a particular company is offering maximum volume, and on the basis of that volume, making the company earn the maximum revenue. So these things you have to analyze, try to see which product is the best and which product is not the best. Though you are not a consultant for that company, like you are just preparing a financial model or trying to do the valuation for that particular company, but you have to see that which particular unit or which particular department making those particular products command the maximum revenue for the company. So, for example, it can happen that a particular company manufactures 10 products, but out of those 10 products, just 8 products are viable and bring the maximum revenue to the company, whereas the demand for the rest two products is almost nil. People are not buying those two products. The demand for the products are falling and falling. And ultimately, these two products are ultimately, or I would say directly or indirectly, creating a cost pressure upon the company because these are the non-viable units, and or maybe these products are not bringing adequate revenue to the company. So what can be done in that scenario? Though since you are not a consultant and you would not be in a position to advise that company, since your role is just to do some equity work or equity research upon these particular stocks, but these things you can analyze. If these two units or these two departments are discarded or discontinued, the company can focus more effectively and efficiently upon the other 8 products, and maybe the revenue or the profitability of the company can increase and the cost might come down. So if you are into a consultant role, then you have that right to advise to the company that these units or these departments or these products are discarded. These are unviable. People are not buying these products, but you are continuously investing into these products, into these kinds of stuff, and directly or indirectly creating a cost pressure upon the company, which is unviable, right? So all these things need to be taken into consideration when you are analyzing the company. You need to read about the management discussion and analysis, MDA analysis. You need to do. We tend to call in the short form terminology as MDA, management discussion and analysis. So these things you have to do, right? That what the management is talking about the particular corporate. For these, you might hear the different news channels or might refer to the different finance news channels like CNBC or Z Business that particularly call these CEOs or chairmen of these companies, and they talk about the future profitability, the cash flows, investments, diversifications, expansion opportunities for these companies, which might increase their revenue, might bring economies of scale or cut down costs or try to like digitalize the business or bring in AI to like facilitate more operations, improve supply chain, or deliberately improve the production chain or distribution channels, the product, the pricing, the place, and the promotion of the product, the 4 P's of marketing as we talk about. So all these things can be talked about by that management. So there you'll understand that person who is the equity researcher who is trying to analyze and prepare a financial model of that particular company will get to know that how all these commentaries, right, which the management of the company is portraying or talking about or speaking about in those management discussions, how will that have a positive or a negative impact upon the different parameters of the company, be it the sales, be it the EBITDA margin, be it the profit, be it the cash flows, or the further ratios, be it the liquidity ratios, the activity ratios, the capital structure ratios, or maybe the valuation ratios also. because even the valuation ratios are also affected by the sentiment in the market, right? So these things, the products, the management discussion. Some people also argue a third point, that you need to analyze the social activities of the company. This ESG theme, right? Environment, social governance. This ESG theme people have been talking about a lot. That if a company focuses towards this environmental and social governance theme, then only pour your money into that company or invest your money into that company. The company is following that ESG theme, right? So that has been, I would say, a mediocre play, but not so a great play. Because a business, if I talk about from the business point of view, right? There were a lot of arguments and discussions that the companies which produce unethical products like cigarettes or alcohols or something that cause pollution into the environment, like coal or like some kind of bad gases or like unhygienic gases, like which can harm the environment, people should not pour their money into these companies. Ideally, this theme has been more prevalent outside India, though it has come into India as well. Over the year of 2019, 20, 21, all these theme of ESG was there. And these companies, like which were into these unethical themes, were not getting foreign direct investments, FDI, or the FPI is the foreign portfolio investors, or the FII is the foreign institutional investors, were not investing into these companies. But at a later point of time, they realized that one thing that should be taken into consideration as well before making a decision to invest into these companies or not, that if these companies are going toward this ESG theme, toward this environmental social governance themes, this should not come at the profitability, at the cost of the profitability of the company, or at the cost of the increasing free cash flows of the company. That is, if the company is diverting some funds towards this ESG theme, it should not reduce the profitability of the company or should not affect the cash flows of the company negatively. And when they realize that, because ultimately, like whether because the demand for cigarettes would be more, the demand for alcohol would be more, like no one can stop it. And I would say like neither the government can ban it as well, because a lot of excise duty or indirect taxes they get or VAT they get from these sin products, as we popularly call them, right? And also the demand for coal cannot go away, because coal is used to make cements, electricity, marbles, tiles, because the demand for coal cannot go down. Because even if we shift towards the renewable sources of energy, like hydro energy, solar energy, wind energy, that will take time. And we do not have enough capacity. Still, lakhs and lakhs, millions and billions of infrastructure is being laid down, and that will take time to come into place, to come into active place, I would say, because laying down the infrastructure and actively using it are two different things, right? So these things have to be taken into consideration. And as a result, people started to like realize these things, and they sold off or they diverted their money from those companies that were morely focused towards the ESG towards those against sin products. The ITC started to rally. Again, it's not a stock recommendation. ITC started to rally because the majority of the revenue the ITC makes is from cigarettes, right? The alcohol companies like United Breweries and all these companies started to rally, like Radico Khetana, like all those stuffs. Coal India started to rally, and we have seen PSC companies rally over the past 1 year, right? So 40, 50%, like 50, 60%, like PSU index has given a return. PSU, if I talk about on a YTD basis, PSU has given like 20, 30% return. But over on a 1 year basis, the PSUs have given like 80, 90, 100% returns. So that things need to be taken into consideration, right? So the money started to get diverted from these ESG themes to these spaces, whether it was even a sin product. So that one thing we need to realize, the sin products, be it alcohol, be it cigarettes, or some companies like which create pollution into the environment, like manufacturing coal. All these companies ethically might not be doing good, but they are doing good on papers, I would say, in terms of their financials. Their profitability is rising, their cash flows are rising, right? And the major objective of the business is to create profit and maximize shareholders' wealth. The two major objectives of the business, as we're popularly taught in the corporate finance classes as well, like for all of those who are like undergraduates or postgraduates, be it like any of the curriculums. This in corporate finance is a curriculum like which is taught in both the undergraduation and the post graduation. And a very common thing that is taught in the financial management subject, a business exists to create profits as a number one objective, and the number two objective is to maximize shareholders' wealth. Even if it, because even if it is at the cost of harming the environment, so that is silent. But the business ultimately who is making the profitability or increasing the cash flows, people, the the FIIs, the domestic individual investors, HNIs, FPIs, FDIs, will still invest into those companies because ultimately, why do people enter into market? People enter into market because they want to make return. They want to maximize their wealth as shareholders. They do not come into the market because they want to favor the ESG theme, even if the company goes bankrupt or the company is making losses. So ESG, as for now, is a good acronym like to go for, but it is only good if the company is making the profitability as well. So that amount of profitability or like good profitability should also be there. So that things we need to take into consideration. Okay, so like these are the things. You need to check about the industry wide. Like for example, if you talk about the FMCG company and your target company on which you are preparing an equity research report, right, is an FMCG company. So then you need to learn and analyze the FMCG sector as a whole as well. How is the FMCG sector performing? What has been the growth rate in the past? What is the current growth rate? What is the future growth rate? What challenges this FMCG sector can face in? So a sector as a whole and company as a whole, you need to analyze. And how to dive into a company, we know that all kinds of financial ratios, like preparing that financial models and making an opinion about the valuation of the company. So all these things need to be taken into consideration when you're doing such stuff. Any questions till now? Let's take a pause because I was having a few of the questions. Yeah, Arnav. So like Arnav on the chat box is talking about what he's talking about the macro indicators. Like we have the gross domestic product, GDP, the GDP, we have inflation, we have the purchasers managers index, PMI numbers, we have the IIP, the index of industrial production. So all these macro indicators, inflation, of course, they also tell us about how a particular company might do because ultimately the raw material pricing for these FMCG space or any of the companies I would say also affects the profitability of the company. Because for example, if you are into an FMCG space and you want to manufacture biscuits or make biscuits, so what are the raw materials which are used in making biscuits? There might be some wheat or flour, some maida, there might be some oil or sugar or salt, right? So all these are raw materials. If the global prices are rising in the world, like because of, I would say, the shortage of supply, or like because of some natural calamities, or because of some labor strike somewhere, ultimately these raw materials will have to be purchased at a higher price. And when these are purchased at a higher price and those cost is not passed on to consumer, because you ultimately cannot pass on the cost to consumer directly. So that will take time, right? So if you have purchased something at 200 rupees and you are selling it at 300 rupees, but now the 200 rupees has risen to like 300 rupees. So like you purchased at 300 rupees and you sold at 300 rupees. You are not making any profits or negligible profits. And as a result, the profitability of the company comes down. And over the gradual period of time, they start to increase the prices or they start to shrink the size of the packets at the same price. And that is called shrinkflation, right? So these things are done. And the same is for the other industries also, like be it like you are manufacturing steel or cement, right? अब steel cement बनाने के लिए you tend to require your pet coal, right? So if the prices of the pet coal rises in the other markets, be it Australia or the Mexico, because these companies, these countries tend to manufacture and export coal. Again, the prices of steel and cement would rise. Again, steel might be an input for an automobile, right? If the prices of coal has risen, ultimately the prices of steel will rise. If Tata Steel is purchasing steel at a higher price, again they will sell it off to Maruti Suzuki at a higher price. So again, if one input is increasing, the other line of chain is related. It's a circle, it's a vicious circle. And again, the cement might be an input for housing, right? But housing pricing is rising, the coal price is rising, so ultimately the cement price also rises, correct? And if the cement prices rises, the cost of construction of the house will rise because your coal is used in cement, in marble, and like XYZ stuff. And again, if the oil pricing is rising, the oil is an ingredient in paints, the paints price will rise, right? So all these things like we need to understand because these are related to one another. Okay, Anish? Any more questions? So I'm skipping a large variety of questions also because I've already talked about it just to save some time. Yeah, capacity utilization is also a good metric. I've talked about all these metrics in one of my LinkedIn posts as well. Right. So, like for example, if a company has 100 machines and just 20 machines are being used, so it means it is underutilized. Either the demand is not there or the rest of the 80% machines are like not working. Okay. So at least a company or a factory should operate by more than 50% capacity. More than 50% of the machinery should be continuously working. And these things need to be taken into consideration. And how will you get these numbers? These capacity utilization numbers might be difficult to get. PMI, like inflation, IIP, GDP numbers are publicly available. That capacity number, either that number gets published monthly, or the people who are the consultant role mein jo hote hain, they get that number from the company directly. Okay, but that capacity utilization number is still a bit tough to get, but that number still gets published on Google. Okay, so that is one thing. Any more questions? Or I will ask one question from you guys. So my question to you is just answer in the chat box. We have seen a large amount of companies come up with their IPOs, right? Those companies are making losses. The PAT or the EBIT of that company is negative, but these companies are positive at your EBITDA level. That is their earnings before interest, tax, depreciation and amortization. EBITDA level पे वो profitable हैं, right? So what can be the major reason why these companies are loss making at the PAT level, at the EBIT level, but these companies are profitable at the EBITDA level? मतलब EBITDA पे they are making profit, which has not taken into consideration the impact of depreciation, amortization. But at your EBIT level, these companies are making into losses, or these companies or the PAT is into losses. Any answers? I've already hinted the answer, like when I talked about the depreciation and the amortization. Correct, correct. So like Raghav has given almost the correct answer. See, like what basically happens, inventory का इसमें ज्यादा रोल नहीं है. The thing is, EBITDA, it has included your depreciation and amortization. It has not subtracted your depreciation or the amortization, right? One way, if we have to reach from EBITDA to your EBIT, EBITDA से अगर EBIT में पहुंचना है, ultimately you have to subtract your depreciation and the amortization, correct? So it can happen that the company has huge fixed assets, because like what basically happens in the starting phases, like when the company has just come up, they do huge capex. Huge capital expenditure is performed by these companies. If you guys have watched my modules, free cash flow to firm or free cash flow to equity of these firms is negative, because capex is an important component when we are calculating that FCFF. We calculate it from your EBIT. We add back the depreciation and the amortization, subtract the changes in the working capital and the capex. And when that working capital or the capex is more, right? So ultimately the free cash flow to firm is negative. Similarly, it can happen that the starting with the company has done huge capex, right? Okay. So the company has done huge capex and there can be huge amount of depreciation and the amortization upon that. that would be more than the amount of this EBITDA. Okay, so as a result, it can happen that your EBIT is negative and PAT is negative, but your EBITDA is positive. So that is like one of the most important reasons, like that you guys needs to understand, because here हम depreciation and amortization को minus नहीं कर रहे. Okay, so that is one thing. Up the second scenario can be EBIT is positive, but your profit after tax is negative. Is it possible? Your EBIT, I would say, very simple answer towards it. Very simple component. Your earnings before that is you have still not paid your interest and tax, right? That component is positive, but the profit after tax is negative. Uh, Completely agreed, Vikram. High leverage component. The company might be paying more interest than its profits. So हो सकता है when the just assume 100 is your EBIT and the company is paying 200 as interest payments. So minus 100 would be your profit after interest, I would say. Because when your after your interest payment, the profitability is negative, the tax won't be charged on it, right? Still, people tend to call it as profit after tax because that's a general term. But simply, you people can still write PAT, it's fine. But ultimately, when the firm has negative profits or losses after those interest payments, correct? The firm won't be paying any taxes. Now, the third scenario. Tell me, in what cases your profit after tax can be more than your EBIT? Ideally, your PAT should be less than EBIT because you have paid those interest payments and tax payments. In what scenario, PAT, I'm talking about the reverse scenario, will be more than your EBIT. The final profit of the company would be more than your EBIT. Quite tricky. Same happened with Zomato, I guess. As Zomato became operationally profitable, but that was not on account of, the, I would say, the operations of the business, like more or less. I talked about the concept of deferred tax assets and deferred tax liabilities in one of my modules. So there was some tax write-backs. Some deferred tax assets had come into place. The company had paid some more tax previously, and there was some tax write-backs. And the company got back that extra amount of tax, right? So that tax got back, right? So like one of the reasons, so that got added into PAT. The second reason can be, as like one of my friends told, income from other sources. Okay. Income from other sources ideally is a part of revenue in the top line. Income from other sources is a part of revenue in the top line. Mesh. Okay. Income from discontinued operations or discarded operations is a part which can be added back to PAT. If some discontinued operation or discontinued business, the company has sold off that part, like for example, I gave you the example of the 10 products and 8 were good and 2 were sold off. So वहां से जो पैसा company कमा रही है, like whatever kind of money or revenue the company is making from those products, which have been discontinued, discarded because they were unviable. Again, that amount is nothing but the income from discontinued operations. Those get right back. Right? So these can be the reasons why your PAT, it can be more than your EBIT. So these things you need to understand. Last but not the least, one factor we need to understand is we always need to see the correlation. Here I would say the correlation between your marketing expenses and your EBITDA. A very important metric of correlation which people don't talk about. Because what basically happens in the initial phases, marketing expenditure or some kind of expenditure as a percentage of sales is very high, right? That is rising and your EBITDA is also rising. Correct? What basically we see in the loss-making companies, your marketing expenditure as a percentage of sales is rising and your EBITDA is also rising. But the losses might be increasing or the company might be into the losses phase, right? So in the starting phases or up to like 4 or 5 years, we tend to see a positive correlation between the first component, that is the expenses as a percentage of sales. That's the first component. And the second component, EBITDA. If marketing as a component of sales is rising, EBITDA is also rising. But once this correlation tends to get reversed or tends to have a negative relation, that is, marketing as a percentage of sales is falling because now the company is becoming more mature and the company need not do any marketing because the people know it. And your EBITDA is rising. That's a good scenario. So that correlation should come down and that should become negative. That one thing we need to see in any of the business. So just see that in Mama's IPO. Is that correlation coming down? That's my homework to all of you. मामा अर्थ में देखो कि मार्केटिंग एज अ परसेंटेज ऑफ सेल्स फर्स्ट कंपोनेंट एंड EBITDA का कोरिलेशन कम हो रहा है या नहीं हो रहा. Okay. Any questions from your end? I won't make the session too complex because I've talked about too much complexity today, talking about the different relations, correlations, EBITDA, PAT, EBIT. Any questions? Yeah, to learn more about EBITDA, KP, you need to like refer my modules first. Okay. And if you still don't try to understand, like if you still don't understand it through the modules, then you can easily get back to me. No worries for that. Okay. Ashna is asking one question. Can we have the bifurcation of the marketing expenses? Marketing expenses ka bifurcation, ideally they don't give. But in some of the cases, you can find in the notes to accounts. Because they go in the P&L, like you have those expenses. But expenses तुमको नहीं पता किस चीज के हैं. So those expenses का bifurcation you can get in the notes to account. Some marketing expenses, some promotion expenses. But the bifurcation of the marketing expenses वो तुमको नहीं मिलेगा. Okay. That is one thing. So that's a bifurcation, like within the bifurcation you are asking. So that is not present in the annual report of the company, like even in the notes to accounts. Some company might do it, but in my experience, I've not seen the bifurcation of the marketing expenses. I've seen the bifurcation of expenses in the notes to accounts, but the bifurcation of notes to accounts, I've not seen. That's one thing. Any more questions? If no more questions, then we can end the session for today and get back the next week. I hope you guys had a good Diwali. So yeah, so we'll be having like regular sessions now every week. Okay, guys, thank you. Take care.